If you ever trade an opening range breakout, you already know this feeling. Price breaks the high, you go long, and 30 seconds later you're stopped out, while the market runs in the exact opposite direction. That's not bad luck, that's a model showing you half the picture. The orb tells you that price broke a level. It never tells you who broke it, or whether they actually meant it. In the next 30 minutes, I show you the other half. How to read who is genuinely in control of the auction before you press the button. No intuition, no gut feeling, just the data. I'm David, you won't see my face, you'll see my process. That's the whole point. Most of retail trading runs on discretion. I felt like it was going to reserve. I felt like it was going to reverse. The candle looked strong. That's not a strategy, that's an horoscope. What I do is the opposite. Systematic, order flow based decisions you can write down, test and repeat. I take the way institutions actually read the market. Supply, demand who is aggressive, who's trapped, and I strip it down so a retail trader can use it on a single chart. Today's example, it's my OVB model, opening volume breakout. It's the ORB you already know, rebuilt so it can answer the one question price alone never could. Who is really in control? Let's deep dive into it. Here is the classic model. You mark the high of the low and the opening range, the first block of the session, right? Price closes above high or above low or below the low. You go short, you go long. Here's the classic model. You mark the high and the low of the opening range, the first block of the session. Price closes above the high, you go long. Below the low, you go short. That's it. Clean, simple, and it's been taught for decades. The problem is that the simple isn't the same as complete, and this model has two holes you can drive a truck through. Problem 1. False breakouts. Price pokes above the range. Every ORB trader in the world buys the same candle at the same place, and then it collapses back inside. You didn't get a breakout, you were the breakout. You were the liquidity someone else used to get filled. And there's the part price action can tell you. Was that a real move that failed, or was it never real to begin with? Looking at the candles alone, you genuinely cannot know. Problem number 2. No visibility into control of the auction, and this is the most important, which brings us to problem 2, and this is the big one. A price chart shows you where trades happened. It does not show you who's doing the trade or how hard they were pushing. The market is an auction. At every moment there's a buyer trying to take control and sellers trying to take control, and one of them is winning. Price is just the scoreboard. It's the result. By the time the score changes, the flight is already over. The opening range breakout makes you bet on the result while you're blind to the flight. That's the whole flow, and that's exactly the gap the OVB closes. Just to be more precise, what I mean is that inside of the initial auction of the opening range, we see just the price, but we don't see if here buyers are in control or sellers are in control. But let's wait a minute, because I will show you now the best instrument to spot this auction. So my OVB keeps the skeleton of the ORB. We still care about breakouts, we still care about the opening, but before we trade a single one, we answer the question, the opening range breakout count. Who is actually in control? And we answer it with volume, order flow, and one proprietary read I'll show you later. But before of any technical stuff, I want to show you why I trust this at all. This is a validation dashboard based on the first 6 months of this year, from 5th of January, as you can see here, and 22nd of June 2026, of course. Within 78 trading days, I traded this model, and within over 100 trades, exactly 115. Let's zoom in just to show you better. This is the equity curve, you can see it's very smooth, and this is the underwater curve, the drawdown, never under the initial account balance. So this is very important for prop firm traders, of course, because on prop firm you don't want to hit your drawdown target, right? So this is one of the best models you can trade, and the net return is around 39%, 30k, over 30k, with a 58.3 win rate, 3.66 profit factor. So it's really nice. And the risk reward, I can see it here, the average risk reward realized, so the real one, it's 1.53. Okay, these are all the metrics, all the validation metrics. You can see the max drawdown was minus 2k, so less than 2%, and this is very nice, and this is just a projection, you can see. One thing I want to clarify, this is based on my trades, okay? This is a dashboard I produced to collect all the data on the trades I really traded this year, so someday could be missed. As you can see, we have January, February, March, April, May and June. Nice profits, every month in profit, and here are all the execution. This data was collected with a fixed risk-reward ratio in the initial trade. What does it mean? That I put maximum $500 stop loss and $100 target, so 1:2 risk-reward ratio, and these are the metrics. So now I think we can deep dive this model so I can give you the exact process. But before all, I just want to show you the tool that I use for the auction. Here is the tool that fixes the blind spot. Instead of plotting volume by time, for example, to qualify breakouts, the bars at the bottom, a volume profile plots volume by price. How much was actually traded at every single level. So this is the way I use the volume profile. 3 shapes. The shape of that profile tells you who's winning. 3 that matter. The D shape, the first one, is a balanced market, no trend inside. Flat, balanced belly in the middle. The letter D, so you can see this is the D letter. This is a two-sided auction. Buyers and sellers are agreeing on a fair price, and neither one has won. So I don't force direction. On a D, I wait and I'll take the break. Either way, once the market price aside. So just to be clear, I use volume profile to qualify the initial auction. If I have a balanced market, I wait for a breakout on the high or on the low of the value area. This is the real difference. If the first auction is a P shape, I use to take long trades because the initial auction was told us that buyers are in control. And the same is for the short imbalance market, which has a B as a letter, as a reference letter. This is the B shape. So I use profile to qualify the initial auction. Which is the initial auction? The first 15 minutes of the session. So you can auto-plot the volume profile on every platform, but of course if you want cleaner data, you have to use some order flow platform as ATAS, deep charts, and so on. If you plot on TradingView, you can have, of course, nice data. It's better than trade only with price action, but it's not the same because you don't have the real data feed. So let's deep dive more in this profile, and this is the exact model that I use. If I have a D model, I used to wait a breakout that could happen also before, I don't know, 10, 15, 20 minutes. So this is just the initial balance, M50 profile. I wait for the breakout on the high or on the low because this is balanced market. So if I have a balanced market, I don't know who is in control. You can spot here the difference because if you see just the price, does mean nothing. If you have the profile, I wait the breakout, but not of the maximum price, okay? Not of the high, not of the low. This is the real difference. I wait for breakouts of the value area. The volume profile has the 70% of volume exchanged during these 15 minutes inside this value area. The rest outside. So when the price breaks above or below the value area, this is my entry. For the P model, we have a different configuration because we have an initial auction that tells us within the volume that buyers are in control. So in that case, I just took trade if the volume profile, the breakout is on the value area high, of course, because the volume tells us that buyers are in control. And in the exact way, I do the same for the B model. So if in the first 15 minutes of the session, I have a sell distribution, sellers are in control, I wait for the breakout of the value area low. These are just a little invert, okay. We have to invert here. And that's the model, as simple as that. But there are a lot of difference within the classic model because here you can use the volume to tell you the truth, especially for the initial auction. But and this is a really important point. Before the break, I want to see one more thing. A failed auction. Remember, this is an auction. All the market is an auction. When price pushes above the value area high, that's buyers trying to expand value upward, trying to auction higher. If they succeed, value moves up and they're in control. But if they push up there and get rejected straight back in, that auction failed. The buyers tried and the sellers slammed the door. A failed auction of buyers ends control of the sellers. A failed auction of the sellers ends control of the buyer. This is the tell that breakout is real, because I just watched the other side try and fail. And this is very important. Let me show you this on the platform. This is the opening session of the 7th of July, so some days ago. And that's the first profile, the first 15 minutes of the New York opening session, the cash session, of course. What we can see here, at the top of the auction, we see a lot of buyers that are stuck here. These buyers are called trapped buyers. Why? Because they try to push the price higher, but they fail. So aggressive sellers step in, and I use big trades indicators to spot this type of failed auction. This failed auction took place above the value area high. So this, for me, it's a big and clear sell signal, okay? And as you can see, this profile is a B shape. Let me just highlight it. The shape of the first profile is a perfect B, okay? So after this B distribution and these trapped buyers, we are just ready to wait for the breakout. But there is another problem. How do we spot the real breakout? And this is the step 5, was confirmation. This is how I do it, and it's the piece that keeps me out of the fake outs the opening range breakout walks straight into. Raw delta just tells you the net of aggressive buying versus aggressive selling. Who is hitting the market instead? Step 5, and this is how I do it. To qualify the real breakout, I built these indicators you can see as red diamonds. Of course, I have also green diamonds for the buyers, but now the auction is a sell auction, is a selling auction, so we are just waiting for the short breakout. These indicators show me the best part of order flow. It doesn't measure which side is aggressive. It measures how hard they are pushing at the moment of the break. When the price breaks the value area hedge in the direction of my letter, and in this case is a B letter, and delta aggression confirms that the aggressive side is generally leaning in, that's a real break. If price breakouts but the aggression isn't there, that's a move with no one behind it. That's a fake out, and I skip it. So if you want to analyze this trade, I wait for a candle within at least 3 diamonds inside. So this is my trade. I open it market order within a fixed stop loss of 40 ticks that are with one contract on yes are like $500 and a target of 80 ticks fixed, so $1,000 in just 20 minutes. This indicator shows me the real breakout. So to repeat the model, if you highlight the value area high, the value area low, you wait for the formation of this 15 minutes profile, you spot the letter, in this case is a B. You can use big trades to see if you have aggressive buyers trapped on the top of this auction. That means that they are stuck, so sellers are in control. Aggressive sellers are now joining the party, and the break comes in with this candle within 3 diamonds inside. So this is for me a perfect setup. So this is a ready-to-use model you can backtest. Here is the part most trading channels skip, and it's the only part that actually matters. Everything I just showed you, the shapes, the value area, the failed auction, the aggression, no one of it means anything until it's backtested. Because a setup that looks perfect on one chart is worthless. The question is never, did it work this time? The question is, across hundreds of times, does it make money? And when does it fail? That's what backtesting gives you. It turns an opinion into a number. It tells you your real win rate, your real expectancy, and the exact condition where this model is supposed to lose. So you're never surprised. That's the difference between trading a system and gambling on a story. Discretion says, I think this will work. A backtested system says, this has worked, Here is how often, and here when it won't. This has worked. Here's how often, and here's when it won't. One of those you can build a career on. This was the simplified version of the OVB model I developed during these years. If you want the full model, the extra layers, the live setups, and now I actually feed these into the validation dashboard, follow along. I break down one systematic idea at a time. No phases, no hype, just the process. Stop trading the scoreboard. Start reading the auction. I'll see you in the next one.